We are covering the 7 top actively traded stocks that are bullish today. While watching price actions, let us inform you, our review on TSLA. Tesla Incorporated is once again making waves, and there's a lot for investors to keep an eye on. First off, let's talk about the exciting news. Tesla is about to make a big splash in Saudi Arabia with a launch event scheduled for next month. This is significant because Saudi Arabia has been positioning itself as a major player in the electric vehicle (EV) market, and Tesla's entry into this market represents a substantial growth opportunity. The event will showcase Tesla's popular vehicles, including the Model Y, Model 3, and, of course, the highly anticipated Cybertruck. With Saudi Arabia being a relatively untapped market for Tesla, this could pave the way for stronger international growth and bring in a new wave of potential customers. The fact that they're holding an event like this only builds anticipation and excitement, so it's definitely something to watch. For investors, this is a sign that Tesla isn't slowing down in its global expansion efforts, and it could create new avenues for revenue in the Middle East, which is exciting for long-term growth. Now, not everything is looking rosy for Tesla, especially in terms of its relationship with Canada. The Canadian government has made a pretty big move by excluding Tesla from its electric vehicle (EV) rebate programs. This decision comes as a direct response to the ongoing trade tensions and tariffs between the U.S. and Canada. For context, Tesla has been one of the biggest beneficiaries of these rebates, bringing in nearly 713 million Canadian dollars since 2019. But now, Canada has put a freeze on 43 million Canadian dollar worth of rebate payments, and they've gone as far as to say Tesla will no longer be eligible for any future rebate programs as long as the current U.S. tariffs remain in place. What's behind this decision? It stems from concerns about Tesla's handling of the rebate program. Some officials believe that Tesla has exploited the system, particularly by bringing in vehicles built outside Canada, like in China, and still claiming incentives for them. This, combined with controversial remarks from CEO Elon Musk, particularly his dismissive comments about Canada, has made the relationship more strained. For Tesla, this exclusion from the rebate programs is a notable setback because it could hurt their sales and market share in Canada, where they've enjoyed strong demand for their EVs. For investors, this situation adds a layer of uncertainty. While the launch in Saudi Arabia is a major win and shows Tesla's continued global ambition, the friction with Canada could lead to some volatility in the short term. Tesla will need to figure out how to navigate these trade tensions, especially in a market like Canada, where they've seen significant success. The Canadian government's decision also comes at a time when other provinces have moved to cut Tesla out of certain incentive programs, which could signal broader regulatory challenges for the company in North America. So, what does this mean for Tesla's stock performance moving forward? On the one hand, the global expansion into Saudi Arabia is exciting and shows that Tesla is pushing ahead with its international strategy. On the other hand, the friction with Canada, where Tesla has enjoyed lucrative incentives, could dampen its growth prospects in that region. Investors will need to keep a close eye on how these international developments unfold and how Tesla addresses these regulatory and trade-related challenges. While there's plenty of optimism surrounding Tesla's long-term potential, these recent developments suggest that short-term volatility could be a factor in the near future. It's a balancing act, and Tesla's ability to manage these issues could have a big impact on its stock price. Our review on FCX. Freeport-McMoRan Inc. is a major player in the global metals market, particularly when it comes to copper. They've got a solid mix of operations spanning across North America, South America, and Indonesia, with copper being at the heart of their business. Their diverse portfolio, including big names like the Morenci mine in Arizona and Cerro Verde in Peru, positions them well in the global metals market. So, what's been happening with Freeport-McMoRan lately? Copper has been a hot topic, especially since prices just hit new all-time highs. This is driving a surge in interest for miners like Freeport. The company benefits directly from the rising demand for copper, which is being fueled by stimulus policies in both China and the US. With tariffs and shifting trade dynamics, there's a lot of movement in the market, making copper a sought-after commodity. Investors are definitely feeling the momentum in this space, as the demand for copper continues to outstrip supply. Wall Street took a bit of a breather recently, as investors digested some concerning reports, like the drop in consumer confidence. But despite the uncertainty in other sectors, miners like Freeport are seeing a boost. With copper hitting record highs, it's clear that Freeport-McMoRan is in a sweet spot. The company's ability to scale its operations, paired with strong copper demand, puts it in an advantageous position for growth in the near term. For investors, Freeport is one of those companies that thrives when the price of copper rises, and with the current market conditions, it looks like this trend could continue. However, there's always the broader macroeconomic environment to consider, especially with fluctuating consumer confidence and rising inflation. Still, Freeport's position in the copper market gives it a solid foundation, and with the increasing importance of metals like copper in various industries, including renewable energy, their prospects remain strong. If you're looking for a play in the metals space, Freeport-McMoRan is definitely one to keep an eye on as copper continues to soar. Our review on CX. Cemex SAB de CV is a global leader in construction materials, providing a wide range of products, including cement, ready-mix concrete, and aggregates. Operating in over 50 countries, Cemex plays a pivotal role in construction projects across North America, Europe, Latin America, and beyond, with major production facilities located in key regions like Mexico, the US, Spain, and Egypt. The company's recent 2024 integrated report has generated some buzz, showcasing significant progress in both operational efficiency and sustainability. These advancements are especially timely as the construction sector increasingly shifts toward greener practices. Cemex has been pushing to improve its carbon footprint, aligning with the growing demand for more eco-friendly solutions in construction. However, the company is facing some headwinds in the stock market. Morgan Stanley recently downgraded Cemex to a hold, citing concerns over stock performance despite the company's sustainability efforts. That said, the stock still holds a moderate by consensus from analysts, with a target price of $7.50, indicating some optimism for future growth. For investors, this might be a stock to watch closely. Cemex's push for sustainability could open up opportunities, but the recent downgrade serves as a reminder that the market is cautious and the road ahead isn't without its challenges. Our review on IP. International Paper Company is a global leader in sustainable packaging, offering fiber-based packaging and pulp products. With two main segments, industrial packaging and global cellulose fibers, International Paper focuses on creating renewable materials that support everything from product protection to everyday personal care items. They also lead the way in recycling, handling about 1 million tons of paper each year. Recently, the company had its Investor Day, where it shared some pretty promising growth goals. Analysts, like those from Bank of America, were notably encouraged by the direction International Paper is heading, especially after acquiring DS Smith. The potential for growth in the combined business has some investors cautiously optimistic. That said, there's still some caution in the air. The containerboard markets, which play a big role in their packaging segment, can be unpredictable, and macroeconomic risks are something to keep an eye on. While BofA didn't go all in on the growth story, they're feeling positive, maintaining a neutral rating and a price target of $61 for the stock. It's a good sign, but there's still some uncertainty about how things will play out in the near term. For investors, this could be a solid time to watch how the company executes its plans post-acquisition, but it's wise to stay aware of the potential bumps in the road. International Paper is positioning itself for growth, but some caution is still warranted. Our review on DJT. Trump Media and Technology Group Corporation, TMTG, is a social media and technology-focused company known for its platform, Truth Social, where users can create content, engage in open conversations, and follow or be followed without limitations. Beyond social media, TMTG is branching out with the launch of Truth.fi, a financial services and fintech brand, and a TV streaming platform, Truth Plus. Recently, TMTG caught some investor attention with a new partnership with Crypto.com. The deal, a non-binding agreement, will help launch a series of exchange-traded funds, ETFs, under the Truth.fi brand, focused on digital assets and made in America companies. The ETFs will likely include major cryptocurrencies like Bitcoin and Kronos, and the funds are set to launch later this year in the US, Europe, and Asia. This move aligns with TMTG's goal to bring American innovation to the forefront of the digital asset world, with an emphasis on rapid growth and technological innovation, all while steering clear of woke politics. The announcement sent shares of Trump Media and Technology Group up by nearly 9% in pre-market trading, offering a much-needed boost to its stock after a tough start to 2024. Prior to this, the company's stock had taken a significant hit, dropping over 60% due to financial losses, about $400 million in 2024 alone. With this new partnership and the potential to capitalize on the growing interest in cryptocurrency and fintech, investor sentiment has shifted, at least for now. While the excitement around the partnership is clear, investors will need to keep an eye on regulatory approvals for the ETFs and how the company continues to build on this momentum. If TMTG can turn this flashy announcement into long-term success, it could position itself as a unique player in the fintech and crypto space. For now, it's a watch-and-see moment to see if this rally has legs, or if it's just another flash in the pan. Our review on TTD. The Trade Desk Incorporated is an advertising technology company that enables brands to run smart, data-driven ad campaigns across a variety of platforms, like connected TV, video, mobile, and digital billboards. Their self-service, cloud-based platform allows advertisers to plan, optimize, and measure campaigns all in one place, reaching consumers on all kinds of devices, smartphones, computers, TVs, and more. This makes it easier for companies to tap into the world of programmatic advertising, where ads are automatically bought and sold in real time, based on data insights. Recently, the Trade Desk has been in the spotlight after receiving a rating upgrade from Seat analyst Angelo Zeno. He believes the stock is now in a very attractive position, especially with its current valuation being its lowest since it went public. Zeno has set a price target of $97, suggesting the stock could climb by over 56% from its current level, which is a pretty optimistic outlook given the circumstances. Now, why the stock drop? The company's stock has had a rough year so far, down 47% in 2025, largely due to some disappointing earnings reports. In their most recent quarter, while the Trade Desk beat expectations on earnings per share, their revenue came in a bit lower than what Wall Street had forecast. This led to a pretty sharp 26% drop in the stock price right after the report. But despite some concerns about slower growth with expectations for 2025 at 15-20%, the slowest rate in 8 years, Zeno is still confident in the company's long-term prospects. He points to key growth drivers like connected TV, international expansion, and the growing trend of retail media, which could keep the Trade Desk growing at a pace that's 1.5 to 2 times faster than the overall digital ad market through 2026. Zeno also highlights that the shift toward ad-supported platforms like streaming services could give the Trade Desk a solid tailwind, helping it continue to grow despite some of the broader challenges in the advertising space. So, in short, while the Trade Desk has had its struggles recently, analysts like Zeno still see a lot of potential in the stock. With the current price sitting low, this could be an opportunity for investors to get in before things turn around. especially if they believe in the growth of programmatic advertising and digital TV in the coming years. Our review on EQX. Equinox Gold Corporation is a Canadian mining company with a solid portfolio of 8 gold mines spread across the Americas, including operations in Brazil, Mexico, and Canada. Its mines, such as the Aurizona Gold Mine in Brazil and the Los Filos Mine Complex in Mexico, are key assets, and the company is also heavily invested in expanding projects like Greenstone in Ontario and Los Filos. Lately, Equinox has been facing some pressure from rising costs and the unpredictable nature of gold production. The gold market's volatility adds another layer of uncertainty. However, the company's strategy of expanding its existing mines and pushing forward with key projects is showing potential for growth in the long term. For investors, this is a bit of a mixed bag. In the short term, the stock's performance could be affected by challenges at its operations and fluctuations in gold prices. But if gold prices remain strong and its expansion projects continue to progress, there's room for significant upside. It's a stock to keep an eye on, especially for those willing to navigate the inherent risks of the mining industry. Please subscribe, give the video a like, and watch more from our playlist. Thanks!